When somebody hires a professional manager to handle the management of their assets, they should expect a different process than what somebody would do on their own, right? There are many advisors today that still look in the rearview mirror and select a manager based on past performance, which is really not a good process because they're hoping that they can generate those same returns in the future. But what if the manager's success is really just based on luck, or that he's less likely to repeat that successful recent performance? And I wish it were not the case, guys, but that is what the research shows. Again, we would say that is not a great way to start an advisory relationship. I've been doing this for about 30 years, and there is a better way. There's a lot of financial science and a lot of empirical evidence that supports a way of investing that may have periods of underperformance in the short term, but in the long term, if history repeats itself, which we hope it's going to, it will provide a better investment experience going forward. So we believe that, again, we should let the best research, let the best arguments, the best ideas win in kind of guiding our investment philosophy. And so what we've done is we've taken this kind of academic research and we put it into practical application. So from a 50,000-foot view, we leverage what's called premiums or excess returns or factors. They're called many different things that have prevailed over time, over the long term. And what happens is this allows us to bypass what we call traditional money management, which relies on market forces that we cannot control, like forecasting and like stock picking and like market timing. All those things that generally don't work, and we know that. But by employing these premiums, these factors, in a sense, what we're doing is we're just taking broad indexes and we're making them smart with the data that show a very high probability of success over full market cycles. So this allows our clients, I think, to keep as much of the earnings and the growth as possible, going forward. Everybody always asks too, how are you going to protect me, in the markets? And we try and imagine all of the risks and all of the things that can go wrong in the current economy. And then we use some very intelligent software to kind of model these scenarios and the likely effects that they're going to have on our portfolios. So this then drives the model allocations that we select to really try to minimize the impact of the outcomes on our portfolio assets. We also use shorter term, higher quality securities, on the bond side to help protect in the downside. And then because one of our factors is price, we paid attention to price. On our stock side of the market, they're less likely to be giving back these large excess premiums that they might be trading at when the market corrects. And we're really seeing that in the recent outperformance because of, again, all of these very high priced stocks giving back a lot of those gains, right? I would say another thing, behavioral finance is actually so important. If we can help our clients change the way that they think about markets and the misperceptions that they might have, they become better investors. And we see this over time. And then it's our job, to coach them through the various business cycles and markets and to help them be more successful by putting them in the best position to win in these premiums in the long run. And that's really what a coach does, right? It gives us the best possible chance of success and the best possible chance of reaching our goals. So helping our clients focus on the things that are important and the things that we can control is, an insight that we just generally don't see in the average investor. Being able to remove the emotion from investing is also, again, just a tremendous asset because then decisions can be based on, quantitative research and not just the mood of the day or the mood of the times. So, we look at markets have risks, and thank God they do, because again, we would never be able to make any money You know, it's the risk premiums that are out there that we can earn. And we love the old saying, again, where there's no risk, there's no opportunity. So, you know, the philosophy that we share is something that's very easy to understand, it's very easy to communicate, and it also helps us do, I think, one of the most detrimental things to a manager relationship early on is you tend to overpromise and then underperform because, again, you're looking in the rearview mirror. So we try to manage expectations and educate our clients to be better investors, both academically and emotionally. Again, I think there's an emotional intelligence that goes along with that as well. So, guys, we would encourage you, if you have any questions about what we do or how we do it, reach out to the website, ask for an appointment, make a call. We'd be glad to help you in any way we can. Happy investing and good luck to you.